Okay, let's unpack this. We're diving deep into the recent Lululemon Athletica earnings call.
Right.
We've got the transcript, the key data points, and our mission really is to cut through it all and get you the essential takeaways.
Exactly. How did they do in Q1 fiscal 25? What's management thinking? And, what's the outlook?
Yeah, what's on the horizon? Think of this as your fast-track guide to understanding Lululemon right now.
From the numbers, the strategy, to how they're dealing with big things like tariffs and maybe more careful consumer.
All right, so let's hit the headlines first. What were those core Q1 numbers they reported?
Okay, so for the first quarter, total revenue grew 7%. That's 8% if you strip out the currency fluctuation, so constant currency.
Which brought them to?
$2.44 billion on the top line. Gross margin looked pretty strong at 58.3%.
That's an increase, right?
Yeah, a nice 60 basis point increase compared to last year.
And just quickly, basis points for anyone maybe not deep in financial reports daily, 60 basis points is just 0.6%, yeah? A standard way to talk margin changes.
Precisely. Yeah, standard language. And their diluted earnings per share, that came in at $2.60.
And importantly, these results, the revenue, the margin, the EPS, they were actually better than expected, weren't they?
That's a really key point. They beat their own guidance for the quarter. That always signals good operational control. And they showed some confidence, too, buying back stock, $430 million worth in Q1.
How many shares was that?
That was about 1.36 million shares, average price around $316.
Okay, so Q1 itself, a beat. Let's get into the weeds a bit. Where did the growth come from geographically? Any weak spots?
Right. Looking across the map, North America grew 3% reported, 4% in constant currency.
Okay.
But what's interesting there is that the comparable sales, so existing stores and online, were actually down 1% in North America.
So overall revenue up, but the core comparable business dipped slightly there.
Yeah.
How did that split between, say, the U.S. and Canada?
Exactly. Within North America, Canada stayed strong, 9% growth, constant currency. The U.S. market saw 2% growth.
Only 2%.
Yeah, but management specifically pointed this out as an improvement in the trend compared to the last couple of quarters. So still soft maybe, but moving the right way.
An improving trend in the U.S. is definitely something to watch, even if it's not exactly booming yet. What about internationally? That's been a huge focus.
Oh, yeah. International is where you really see the momentum. China, mainland, delivered a strong 22% growth, constant currency.
Wow.
And they did mention the timing of Chinese New Year probably shifted maybe 4 points of growth out of Q1 into last year's Q4.
So underlying trend maybe even stronger?
Suggest that, yeah. And the rest of world segment, that's Asia, Pacific, Europe, etc., also strong, 17% growth, constant currency.
So international is clearly a big driver right now. How did the sales channels look? Stores versus their online business.
Store sales were up 8% in Q1. They ended the quarter with 770 stores globally.
Still opening new ones.
Yep, continuing to expand. Added 3 net new stores in Q1 alone, part of, I think, 59 net new plans since Q1 last year. Digital revenue also grew, up 6%.
And how much is digital now?
$961 million in the quarter. Makes up a pretty big chunk, 41% of total revenue.
And looking at the products, men's, women's, accessories, any standouts?
Actually, growth was pretty balanced. Men's and women's both grew 7%. Accessories and other stuff saw 8% growth. So, yeah, pretty evenly spread.
Okay, let's circle back to that 60 basis point increase in gross margin. What drove that improvement specifically in Q1?
The biggest piece was a 130 basis point jump in product margin. Mostly came from lower product costs and doing better on things like damages and markdowns.
Offsets.
Yeah, partly offset by higher air freight costs that took about 20 basis points away. And foreign exchange was another 20 basis point negative hit. And then there was about 50 basis points of deleverage on fixed costs. So things like rent, depreciation, they grew a little faster than revenue.
So Q1 margin strength mainly came from product cost and markdown management.
Primarily, yes. Compared to their own guidance, which was for basically flat margins, the upside was mainly those lower product costs, doing a bit better than planned on leveraging fixed costs and slightly better markdowns.
Got it. So good operational execution on costs in Q1. How did operating expenses look? The SG&A, sales, general, admin costs.
Right, SG&A, that was 39.8% of revenue. It was up from 38.1% last year.
Higher than planned.
Came in slightly above their guidance, yeah. They said it was mainly due to an FX revaluation loss, basically an accounting thing from currency moves.
And the message there.
Management said they're balancing, prudent expense management with making those necessary strategic investments for growth down the line.
Okay, so putting gross margin and SG&A together, what did that do to operating income?
Operating income landed at 18.5% of revenue for Q1. That's down from 19.6% in Q1 last year. So the higher SG&A more than offset the gross margin gain.
And tax rate.
Their effective tax rate for Q1 was 30.2%.
Okay, and capital expenditures, where's the investment going?
CapEx was $152 million in Q1, up from $131 million last year. It's going towards fueling growth, really. Things like a big distribution center project, store capital new ones, relocations, renovations, and tech upgrades.
All right, let's shift gears a bit. Beyond the pure numbers, what were the key strategic themes? What's management focused on to drive things forward?
A big highlight was product innovation, how guests are responding to new stuff.
Examples.
Well, they mentioned the Women's Define franchise doing well globally. New launches like Daydrift, Shake It Out, apparently got good reactions. For men's, they called out strength in zeroed in and smooth spacer lines. And what's interesting is how they're expanding, beyond just yoga. They talk about 5 key activities: yoga, run, train, golf, tennis, plus lifestyle.
It's broadening the scope.
Yeah, gave examples like a new fast and free short, styles developed from R&D with ultramarathon runners. Oh, and they mentioned positive early feedback on something called a line, no line, tested in 80 stores, planning a full rollout this fall.
Sounds like they're definitely pushing innovation within their core areas.
Yeah.
What about building the brand itself? Any specific activation?
Yes, brand activation is key. They talked about the Summer of a Line campaign, had things like a Lululemon roller rink at the Bottle Rock Music Festival.
Huh, interesting.
And a huge yoga event in Beijing, 5,000 people. They described their approach as this mix of grassroots community stuff plus more traditional media and ambassadors.
Did they mention brand awareness metrics?
They did, specifically noted that unprompted brand awareness in the U.S. grew from the mid-30s% range up to 40% in Q1. That's pretty significant progress.
Okay, one major external thing hitting retail is tariffs. How are they planning to navigate that?
Management definitely acknowledged the uncertainty tariffs create, but they also sounded pretty confident they're well positioned.
Why is that?
They pointed to the strong brand, guest engagement, the value people see, their really strong operating margins, industry leading, they said, and a healthy balance sheet, like $1.3 billion in cash, no debt.
So a position of strength, what are the mitigation strategies?
Being careful with expenses, finding supply chain efficiencies like dual sourcing, talking to vendors and looking at pricing.
Using prices.
Evaluating it. They stressed pricing actions would be targeted, based on how sensitive guests might be for specific items. And importantly, the real impact of these efforts is expected more in the second half of the year.
And their guidance assumes?
Their guidance assumes an incremental 30% tariff rate on goods from China and 10% on other potentially affected countries.
They also talked about the U.S. consumer, right? Sounding a bit hesitant.
That's right. They reiterated U.S. consumers are still cautious, thoughtful about spending. But, and this is a really important point they made, despite that, Lululemon gained market share in premium athletic wear, both men's and women's in the U.S.
So taking share even in a tougher market.
Exactly. Suggests competitive strength. They did note, though, different behavior and traffic between the U.S. and Canada.
Inventory levels are up quite a bit in dollar terms in Q1. Any concerns there?
Dollar inventory was up 23%. But it's crucial, units were up a more moderate 16%.
So the dollar value is inflated by?
Higher cost per unit, yeah. Mostly tariffs and foreign exchange effects driving that dollar increase. Management said they're satisfied with the level and mix, feel it positions them well.
And where's the risk for markdowns?
They pointed pretty clearly to the U.S. market as the main area of risk for potential markdown pressure, tied to those U.S. traffic trends and the competitive promotional scene there.
Okay, let's pivot to the outlook. What do they say about the rest of fiscal 2025 and specifically Q2?
Right, the outlook. For the full year, they actually kept their revenue guidance the same, $11.15 to $11.3 billion.
So no change there despite the U.S. caution?
Nope. That implies reported growth of 5-7%, or maybe 7-8% if you adjust for the extra week they had last year. Maintaining that suggests confidence in international growth and their other plans offsetting the U.S. softness.
And store growth plans remain?
Yep. Still expect 40 to 45 net new stores this year, mostly international, especially China, but 10-15 in the Americas, plus about 40 store optimizations. That leads to low double-digit square footage growth overall.
Now, the margin outlook for the full year did change, didn't it?
Yes, this is where the picture gets a bit more challenging. They now expect full-year gross margin to decrease by about 110 basis points compared to 2024.
And the prior guidance was?
Prior guide was only a 60 basis point decrease, so an additional 50 basis point hit there.
Why the change?
Mainly due to those increased tariffs. It's somewhat offset by their mitigation plans, but not fully. And they also baked in a bit more buffer for potentially higher markdowns. Full-year SG&A leverage is still expected around 50 basis points, similar to before, still impacted by currency headwinds and those ongoing strategic investments in marketing, international, tech, the power of 3x2 stuff.
Okay, so gross margin down more, SG&A leverage about the same.
Yeah.
What's the net effect on the full-year operating margin outlook?
They now expect full-year operating margin to decrease by roughly 160 basis points versus 2024. That pressure is really coming from that tariff impact hitting the gross margin line.
Yeah, the tax rate assumption.
Still expecting around 30% effective tax rate for the full year.
So how does all that filter down to the bottom line? The full-year EPS guidance.
They now expect diluted EPS for the year between $14.50 and $14.78. For context, they did $14.64 last year.
So potentially flat to slightly up or down?
Pretty much in that zone, yeah. That guidance includes the buybacks they've already done this year, but doesn't assume any future ones. And CapEx for the year is still around $740 to $760 million for those investments.
They also gave specific guidance for Q2, the next quarter, and it sounded like Q2 is facing some particularly strong headwinds. Walk us through that.
Yeah, Q2 guidance definitely reflects some distinct near-term pressures hitting all at once. Revenue expected between $2.535 and $2.56 billion. It's about 7-8% growth. They plan 14 net new stores, 9 optimizations in the quarter. But here's where the margin story gets tougher short term. Q2 gross margin is expected to decline about 200 basis points compared to Q2 last year.
Wow, 200 BPPs. Why so much?
It's a combination. Higher occupancy and depreciation costs, those higher tariff rates before mitigation really kicks in, planning for modestly higher markdowns, and FX impacts too.
Okay, that's a big hit to gross margin in Q2. What about SG&A?
SG&A in Q2 is expected to delever even more, by 170 to 190 basis points year over year.
And the drivers there?
Increased foundational investments, depreciation again, strategic brand building, and specifically layering back some expenses like store labor hours, which hits Q2 harder than other quarters.
So combine that 200 basis point gross margin hit with, say, 180 basis points of SG&A deleverage.
Sure.
What's that mean for Q2 operating margin?
You add it up, and the expected year-over-year decrease in operating margin for Q2 is roughly 380 basis points.
That's significant for one quarter.
It is. They explained Q2 last year was a really strong comparison point with big margin gains. This year, you've got tariffs and FX hitting before mitigation, plus those planned investments all landing in Q2.
How does that translate to the Q2 earnings per share guidance then?
Reflecting that margin pressure, they expect Q2 EPS between $2.85 and $2.90. That's down quite a bit from $3.15 in Q2 last year. Q2 tax rate, also around 30%.
And inventory for Q2. Similar story.
Yep. Expect units up low double digits by end of Q2, dollars up in the low 20s. Again, tariffs and FX driving that dollar increase. They noted the unit growth supports newness and laps a unit decline from last year. Similar dynamic expected for the rest of the year.
You mentioned markdowns hitting margins. Can you clarify the outlook there? How does the full year plan compare to Q1 actuals?
Yeah, good clarification. In Q1, markdowns actually declined year over year, down 10 basis points. So better than last year.
But the full year forecast includes higher markdowns.
Right. The full year forecast expects markdowns maybe 10 to 20 basis points above last year, but they explicitly called this prudent planning. Meaning it's a buffer they're building in because of general macro concerns and consumer confidence worries. It's not based on current trends. They aren't actually seeing the need for more markdowns right now.
But they're anticipating.
They noted the U.S. market is promotional, and they're anticipating maybe a spike in promotions in the second half if the economy stays tricky. Their own pricing actions for tariffs won't really start until late Q2, early Q3.
So the higher markdown forecast is more like risk management than a sign of current inventory problems.
Exactly. Planning for a potentially tougher environment, especially in the U.S., not reacting to issues today.
Speaking of the U.S., what did they say about store traffic trends there versus elsewhere?
In Q1, U.S. store traffic saw a moderate decline from Q4 and was still lower than Q4 levels overall. Conversion was pretty steady, maybe slightly down year over year. Average order value was up, though.
And trends into Q2?
No real material change month to month in Q1 or early Q2, they said. U.S. trend holding similar to Q1. China traffic, though, still strong double-digit growth, tracking towards that 25-30% annual revenue growth goal for China.
And geographically, where is that markdown risk concentrated? You touched on it.
They were very clear. The main risk for potential markdown pressure is in the U.S. market, directly linked to those U.S. traffic trends and the competitive promotional landscape there. Not seeing the same global pressure, but bracing for it potentially in the U.S. later this year.
What about China store growth? Any updates?
They have 154 stores there now. Their previous target was around 200, but they definitely signaled opportunity way beyond that. Very happy with new store performance. Still feel early in expanding existing stores there too. The message was long runway for growth in China. And internationally overall, the view is unchanged. Strong double-digit momentum in China, AMA, APAC. Still early days for market share and brand awareness there, getting new guests, engaging existing ones. International was 25% of the business last year. They still see a path to 50-50 long term.
Okay, so let's try to pull this all together. If you're trying to understand Lululemon from this call, what are the absolute key takeaways?
I mean, the main story is they had a strong Q1, beat expectations, especially on margin execution, managing costs and markdowns well. They held their full-year revenue guide.
Which signals confidence, despite the U.S. consumer.
Right, confidence in international innovation offsetting that. But there's this significant tariff headwind hitting margins, especially hitting hard in Q2 before their mitigation plans fully ramp up in the back half.
And despite the U.S. macro, they're gaining share.
Yeah, gaining share in U.S. premium athletic wear shows brand strength. International growth is really the key counterweight to U.S. softness right now.
So it sounds like a company with real underlying strength brand, global momentum, but facing some definite, maybe temporary external pressures and investment impacts, particularly hitting Q2 before things potentially rebalance later in the year.
That's the core tension, I think. You see the strengths. Brand loyalty, market share gains, international boom, innovation, solid financials. But the near-term margin picture, specifically for Q2, is taking a noticeable hit from tariffs, FX, and investments hitting all at once before the countermeasures fully engage.
Okay, that brings us to our This Is Not Financial Advice segment. Time to brainstorm an outrageous but plausible scenario based purely on the call details.
Absolutely. And let's stress again, this is just a thought exercise based only on what we discussed. Definitely not a recommendation for any specific trade.
Right, so based on everything, especially that very explicit guidance for a significant Q2 operating margin drop, almost 400 basis points year over year.
Which they pinned on investments, tariffs before mitigation, FX, and a tough comparison to last year's Q2.
And knowing their own tariff-related price adjustments don't really roll out until late Q2 or Q3. Here's a potential thought.
Given that specific, concentrated Q2 margin squeeze detailed in the guidance, one could maybe theorize a tactical, short-term bearish play. Perhaps something like a put option strategy timed around the Q2 earnings release itself.
The thinking being, you're essentially betting the market might overreact negatively to that very visible, sharp, near-term margin compression they guided for Q2.
Potentially overlooking the maintained full-year revenue outlook, the planned back-half margin recovery from mitigation efforts, and the ongoing international strength. It's a play on the timing and visibility of that Q2 pain versus the potentially less immediate positive factors.
Again, purely exploring a scenario based on the call's specific Q2 guidance details. Definitely not financial advice.
Absolutely not.
Okay, so to wrap up this deep dive then, the core message from Lululemon's call seems to be a company navigating real headwinds, the cautious U.S. consumer, tariffs, but doing so from a fundamental position of strength.
Yeah, leveraging that powerful brand, gaining share even in the tricky U.S. market, driving huge international growth, and continuing to invest in product and infrastructure.
And while Q1 beat expectations, the guidance clearly flags this period of, let's say, specific and temporary margin pressure concentrated in Q2, before those planned mitigation actions hopefully take fuller effect later in the year.
That sums it up well.
So this has been our deep dive into the info shared on that Lululemon earnings call. Remember, it's for your information and understanding, not investment advice.
And maybe a final thought to leave you with. Consider the challenge for a company like this. How do you navigate an environment that's strong in some ways, international, premium demand, but cautious in others, like the broader U.S. consumer?
Does their proven ability to gain share and grow globally ultimately outweigh that near-term financial pinch from external stuff like tariffs and their own strategic investments? That's the question to ponder.
Exactly.
All right, thank you for joining us for this deep dive into Lululemon earnings call. We really encourage you to think critically about all the information presented.